Hi everybody, Howard Friend here. I hope everybody is having a great trading week. Lots of ups and downs as usual. Some very interesting things coming through on the markets. So this week I'm going to be talking about one of my proprietary trading setups, which I call the TNT trading setup. So, as many of you will have noticed by watching my webinars, I've developed a lot of different price action based trading strategies, and many of them feed into my algorithmic trading strategies, and this is one of them. So today I'm going to give you a bit of an insight into what I call the TNT trading setup. So first thing, market price action. So technical theory states that financial markets are driven by mass psychology, and that influences the trading decisions, in other words, the buying and the selling. So when it comes to market psychology, human nature is constant throughout history, and we get these big cycles of greed followed by euphoria. So everybody gets depressed and everybody gets happy, and this is ultimately what drives the markets up and down. So these swings in market psychology are recorded on the charts as price action, and that is really the underlying basis of technical analysis or chart-based analysis. So there are many ways to actually monitor and record price action. There are different bar chart, there are line chart, candlestick bar chart, point and figure charts, and lots of different ways that technicians monitor and measure price action and the underlying psychology. So for my proprietary trading setups, including this one, the TNT trading setup, I use bar charts. So TNT is all about volatility, expansion, and contraction. So markets, they tend to move from different cycles of trend. So markets tend to trend for some time, then they go into a sideways range, and then they start trending again, whether it's in the same direction as before or whether it's in a new direction. Now, volatility also has a similar kind of cycle. So the markets can be highly volatile for some period and then go quiet for another period, and so on and so forth. So we get these kind of volatility expansion cycles followed by volatility contraction cycles. And these are a natural course of events when it comes to market movements. So when trading ranges increase, volatility rises and vice versa. So an increasing size of a trading range is a reflection of higher volatility. And similarly, if the range is small, then that reflects contracting volatility. So volatility, a bit like volume when you study price and volume analysis, volatility usually expands in the direction of the trend and it contracts against the trend during corrections because traders are taking profits and there is much more two-way activity, which results in not as much net change up or down. So we've got this expansion contraction cycle going on all the time. So after volatility contraction, we typically will get volatility expansion as a trend resumes or takes hold. So volatility expansion and contraction setups for me provide some very good trading opportunities. So let's look at volatility expansion and contraction in action. So what we've got here is a little bar chart. We've got a series of bars, price bars. You can see the trend of the price bars is up. And what I've done is I've labeled the bars which are showing volatility expansion as VX and the bar which shows volatility contraction as VC. So as the market expands, as the market moves higher, what you get is on each of these bars, we tend to get higher ranges than on the bars which are counter trend. So on this bar here, we have a counter trend movement, and you can see that the range is a lot smaller. And also the net change, the change between the close and the close previously, is also quite small. So we get this kind of contracting volatility as we get the two-way price action. So the trend is up, but we get to a point where people start to take profits and the market starts to ease back. Okay, so we've got this expand and contract kind of cycle in the direction of the trend usually. So now I'm going to talk a little bit about directional movement. So another feature of a trending market is its ability to see directional movement. That really is the definition of a trend, is directional movement. Now, directional movement can be measured in a number of different ways. You can measure directional movement by comparing the price metrics on a bar to those of the same bar and those of the previous bar. So as an example of this, to compare today's closing price against yesterday's closing price. So that would be the net change based on today to yesterday. You could compare today's close versus today's open, which sometimes can be different from yesterday's close. You can also compare today's close to the high, you compare today's close to the low, etc., etc. There are many different measurements that you can do to measure directional movement. So when I'm looking at directional movement, when I'm trying to gauge it, what I tend to do is compare the closing price against the previous bar's range. So if a market can break, for example, above the previous session's high and stay above it at the end of the session, then we've had quite a strong bullish movement on that particular session. Similarly, if we break through the previous session's low and close below it, often by a significant amount, then that too is a good measure of bearish or negative directional movement. So this movement above yesterday's high, for example, on a daily bar chart, or below yesterday's low and close below it, is known as thrust. So basically what we're talking about is closing outside the previous bar's range is known as defined as thrust. Okay, so this is quite an important concept when it comes to what I'm going to be talking about, TNT. So before we move on, just a bit of a graphical representation of the thrust bar. So this is a bullish thrust bar. So these are two bars. They can be daily bars, they can be weekly bars, they can be 5-minute bars, doesn't matter. Just to any segment of time can be measured using bar charts. So bullish thrust is defined as breaking above the previous session's high, this line here, and closing above it. So that for me represents a good directional movement, breaking through the previous bar's high and closing above it, usually by a significant amount. Okay, that is reflective of bullish price action. Similarly, a bearish thrust is where the market breaks through the previous session's low, trends down, and closes below it. So THR plus, bullish thrust, THR minus, bearish thrust. Okay, so that's thrust bars. So before moving on, let me just show you a few examples of price trends and how thrust bars fit into those price trends. So what I've done, I've taken a few charts here. I'm using TradeStation software, and that gives me the ability to paint a bar according to the criteria that I choose. So what I've done simply is I've said, if the bar was a bullish thrust bar, in other words, the close was above the previous bar's high, paint it blue. Okay, so here, close above previous high, blue bar. Same here, close above previous high, blue bar. Similarly, on the way down, if you close below the previous bar's low, we have bearish thrust, and I painted that bar red. Okay, so here, the market broke through the previous session's low and closed below it. This is a bearish thrust bar. Okay, usually with bearish implications. Okay, and similarly here, the market broke through the previous session's high, closed above it, bullish thrust, and so on and so forth. So what you'll notice, what I've noticed typically with when the market has its trends, we get these series of multiple bars in one direction, followed by multiple bars in another direction, and so on and so forth. So what you'll see is these swings swing to the upside here, blue, blue, sideways, blue, blue, top out, and then a bear swing, red, red, sideways, big red, bottom out, and then up it goes, blue, sideways, blue, top out, red, sideways, red, and so on. So you can see that the components of a trend, what makes up the trend, the dynamics of a trend, if you break the thing down, you'll see lots of these so-called thrust bars within the trend. So it's usually a bit of a clue. If you see one or more thrust bar, it usually gives you a clue as to what the larger trend is, at least in the time frame which you're looking at and maybe trading. So you'll see that this price swing here saw 1, 2, 3, 4 blue thrust bars to the upside. This swing to the downside saw 3 thrust bars to the downside, one of which was quite big. This upswing saw 3 thrust bars to the upside, one of which was quite big, again, exhaustion at the top. And then this one saw 1, 2, 3, 4, and it was still going at the end of its sequence. So the point I'm trying to make here is that if you see one or more of these thrust bars, it gives you a clue as to the larger trend. Now, the concept of thrust bars and non-thrust bars, typically you'll get thrust bars in one direction, followed by non-thrust bars, in other words, these bars which are not blue or red, followed by more thrust bars in the direction of the trend. Similarly here, thrust bars down, sideways, no thrust, and then more trend action down. And when the trend reverses, we have thrust to the upside, no thrust, no thrust, no thrust. Next thrust is to the upside. On the way down, bearish thrust, sideways, no thrust, and then more thrust to the downside, and then kind of sideways action here. Okay, so just to reinforce that point, so here we've got another chart. We have a market which started off with quite a big thrust to the upside, and then a series of non-thrust bars. None of these bars, 1, 2, 3, 4, 5, 6, 7, 8 bars, 8 days actually, this is a daily chart, 8 days which did not see the market break through the previous session's high or low and close beyond it. So no real momentum up or down. Okay, so bullish thrust followed by several bearish or non-thrust bars, and then that was followed by a real kickoff in momentum to the upside. So here we have the market, the trend which we saw initially resuming with thrust, 1, 2, double thrust, sideways, double thrust. Now, at the end of this sequence, the market topped out. There was a couple of non-thrust bars, and then the bears took over. So double thrust to the downside, sideways, non-thrust, big thrust to the downside, couple of sideways non-thrust bars, double thrust, couple of bars to the side, sideways, thrust again. So it's that sequence, it's that pattern of thrust in the direction of the trend, non-thrust usually against the trend. Another example here. This market started off in bear mode, so thrust, thrust, double thrust there, sideways bar, no thrust, followed by another thrust to the downside. Then the market based out with a big thrust here, sideways, no thrust, up, bullish thrust, no thrust, no thrust, no thrust, 3 there, no thrust bars, continuing the trend here. 3 consecutive bars on which the market thrusted. Non-thrust, non-thrust, thrust out of that non-thrust pattern, and then the market started to top out. Bearish thrust, two non-thrust bars here, continuation here. 2 non-thrust bars here, continuation here. Then the market bases out, double thrust, no thrust, continuation. Market tops out, double thrust, no thrust, no thrust, no thrust, there like that, new low, no thrust, and then the bulls came in. Okay, so that's really the kind of the theory behind how thrust bars fit into market trends. So a few notes here about trending phases and thrust bars. So if the trend is up, you'll tend to see several of these bullish thrust bars. In other words, the blue bars, which I showed you. If the trend is down, you will tend to see several bearish thrust bars. Again, the red bars that I showed you. And there are many examples of so-called multiple thrust bars in the direction of the trend. So you'll get double thrust or triple thrust in the direction of the trend, because the market should typically, when it's trending, it should be quite easy for the market to move in one direction or another, the direction of the trend. One thing also of note is that there are not that many thrust bars that go against the trend. I think in the examples that I showed you, there were none, but sometimes you'll get maybe one against the trend and then the trend will resume pretty quickly. But oftentimes you'll find that there are no thrust bars that go against the trend. So just an analysis of thrust bars and non-thrust bars can give you a clue as to which way the trend is likely to be. So that's really what it's all about. When it comes to trading, our job as traders is to determine who is in control of the market and to trade in the direction of who is in control of the market. Okay, so that brings me on to this TNT setup, the subject of the webinar. So as I say, the main objective of the trader is not to guess which way the market is going to go, but to position themselves in the direction of the trend in their own time frame. Okay, so if my time frame is maybe 1, 2, or 3 days, I should be looking most likely at daily bar charts to determine whether I should be positioned long or short or not at all, flat. So if the market is forming multiple bullish thrust bars, then the implication, according to thrust bar analysis, is that the trend is most likely to be up, and therefore, as traders, we should be looking to buy because it's going to be easier to make money buying because the trend is up. If the market is forming multiple bearish thrust bars, in other words, close below previous bar's low, the trend is most likely to be down, and therefore, as traders, we should be looking to sell because we should be making more money if the market wants to go down easier than it goes up. Okay, simple as that. Path of least resistance. So also thrust bars followed by non-thrust bars, they provide an opportunity to enter in the direction of the trend with small risk. So if we have one or more thrust bars followed by a non-thrust bar, that tells us that we've had the market moving in one particular direction, and then the market has stopped moving in that direction in a big way. And that gives us an opportunity to take a trade in the direction of the trend with small risk. So going back to the acronym TNT, I call the setup TNT, which basically stands for thrust, no thrust. TNT. And this is what the TNT buy setup looks like. So remember, the thrust bar is where the market breaks through the previous session's high and then carries on through and closes above that previous session's high. Okay, so again, can be daily chart, can be 5-minute chart, can be hourly chart, can be monthly chart, doesn't matter. The fact is that the market has broken through the previous session's high and closed above it. So that thrust denotes that the buyers are in control in this particular time frame. Okay. Now, as traders, for me, I would not want to be jumping on the market just on the strength of a thrust close, because invariably you've missed out on quite a bit of the action. Really what you want to be doing, in my opinion, is getting in on a breakout after a non-thrust bar. So what we've got here is, first of all, the thrust bar, the bullish thrust bar. So that's first part of the setup, followed by a non-thrust bar. So we've had the T, and then we've had the NT, non-thrust. Because what happened on this bar here is the market broke through the previous session's high, continuing in that trend, but by the end of the session, the market failed to close above that breakout point. So what we had were people that bought the breakout that by the end of the session were losing a bit of money. So I like to talk about this kind of concept in terms of the market. You tend to hear, is the market overbought or oversold? I tend to talk in terms of the market being underbought or undersold. So if the market was overbought at the end of this thrust bar and couldn't really go much higher, then at the end of this non-thrust bar, the market has gone from overbought to underbought because we've had a bit of a correction against the trend. The trend is up. We've had a correction. So now we're looking for the trend to resume. So we've gone from overbought to underbought. So this basically sets us up for the next leg of the trend. So with regards to the setup, what I do here is when I see TNT, I put my buy stop just above the high of the NT bar, because I know that if the market then breaks through this NT bar's high, we're getting a continuation of this trend defined as the thrust followed by no thrust. So the buyers are in control. We've had a little correction. And now as that market is breaking through this red line, the high of the non-thrust bar, it looks like, and there's no guarantees obviously, but it looks like to me that the market is resuming its uptrend. And in a similar way that we look at classical technical analysis like flags and pennants, etc., we are talking about a resumption of the trend, a move to the upside, a pullback, and then as the market breaks out, we're looking to buy it, looking for a kind of repetition or duplication of this kind of move, which preceded the non-thrust bar. So we'd be looking for this kind of move. And that, for me, presents a trading opportunity, a window opportunity to make money on the long side of the market, jumping on a resumption of this trend. Okay, so let me show you a few examples of the TNT buy setup in action. Okay, so here we have a market which is trending higher, obviously. And by the way, these examples I'm going to show you, it doesn't matter what the market is. It doesn't matter what the time frame is. It's just the same old pattern. And it should be kind of rinse and repeat on just about any chart and market that you can care to look at. So this one started off with 1, 2, 3 consecutive bullish thrust bars. So remember, the blue bar is when the market breaks above the previous bar's high and closes above it, denoting strength. Okay, bullish thrust. So 1, 2, 3 consecutive bullish thrust bars. So that tells me that the buyers are in control of the market. Okay, just imagine we haven't seen all this stuff afterwards. We've just looked at it here. So 3 of these consecutive thrust bars say that the buyers are kind of in control and that we should be looking to buy the market on a sign of a pullback. Okay, so we get that on this next bar here. So on this bar, the market breaks through the previous bar's high, but fails to close above it. Okay, so that is a non-thrust bar. So the market broke through this high, but could not close above it by the end of the session. Okay, so we have a TNT bar here. So going back to the rationale of the setup, what I do is I put a buy stop just above the NT bar's high, and the NT bar's high is here, this orange line. Okay, so at the start of this bar, I've got a buy stop just above this orange line, so that if the market breaks through it, I'm going to go long. I'm going to buy the market because I assume that this trend is still in force. So we had a swing to the upside, a non-thrust bar, lower volatility, and we get the breakthrough there. So I'm looking for a ramp up in volatility, which should mirror this kind of action that we saw before. So what happened? The market broke through, continued higher, didn't really go aggressively on the day of entry, but closed just off of the high of the session. And then on the next day, that's when we saw the real aggressive move. So as I say, that is the trading opportunity. TNT, you buy the break of the NT bar, and you're looking for a good move to the upside, mirroring what we saw just before the TNT bar. Okay, so now we get another example on the same chart. So here's a double thrust, and remember, going back to the idea about multiple thrust bars in the direction of the trend, that's quite normal. So the trend is up, we've got 1, 2, 3, then a non-thrust bar, 1, 2. Then we get another non-thrust bar. Turns out to be an inside bar as well, but that's just by the by. So we have a thrust bar followed by a non-thrust bar. So we were overbought here, the market corrected, and now we're underbought, having seen the non-thrust bar. So again, what's the theory? To buy the break of the non-thrust bar, and that assumes that the trend is resuming. So here we put the buy stop just above the high of the NT bar, and we break through, and that's where we buy it, and up it goes for the next 2 bar, maybe 2.5 bars, shall we say, before the market tops out. So we had a little window of opportunity here to make money on the long side of the market, just as we did here. Okay. So that's kind of 2 examples on one chart. Let's look at some more. Okay. So this one starts off with a double thrust, 1, 2, denoting strength. Then we have a non-thrust bar here. The market sees a marginal new high. See how the market breaks slightly above this high here? So we're getting people coming in a little bit late to the party. They buy the break of the second thrust because they need that to be sure. But then the market tops out and then eases back, probably stopping them out as it does. So we've gone from overbought here after the double thrust to underbought after the non-thrust. We've had T, NT. So that's the setup. We draw the orange line above the non-thrust bar's high, the TNT high, and then on this bar we don't break through it, but on this bar we do. This is the resumption of the trend, and up it goes like a rocket. Boom, boom. 2 consecutive days on which the market ramps higher, because we're just basically mirroring this kind of double thrust, no thrust, double thrust, no thrust action. Okay, so this is the place at which I want to be buying the market, on the break of that non-thrust bar. TNT, there's the TNT bar's high. I want to be buying the break of that level there, because that tells me that the buyers are looking to resume the trend. So again, this is another trading opportunity from the long side of the market. Okay, so excuse me, after this double thrust, the market then sees a non-thrust bar. And again, we're in that situation where the market is ready to go up again. Next bar, we break through it, and then we get this big double thrust here, continuing in the trend. Then we get another non-thrust bar here, and then we break through it here. And this time we only get one thrust bar to the upside. And that's probably because the market was kind of topping out after this big move higher. But on the entry day, we had an opportunity to make at least a little bit of money there, or at least move up the stop to break even, I would say. Okay, that's that one. And again, just before we leave this concept, let's show you some more. So this one started off with a double thrust to the upside, giving you some good bullish movement, directional movement. Then we got a non-thrust bar here. We'd put the line in above the high of the non-thrust bar, broke through it on this bar, although it did snap back. But on the next couple of bars, you saw the double thrust to the upside, confirming the trend. Then we got a non-thrust bar here, put the line in right there above the high of the TNT bar. By the break of the TNT bar, up it goes, double thrust. TNT bar, again, put the line in there. That's the TNT bar's high. By the breakout, and boom, 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 into the final high. So you can see how this kind of market action is proving that theory. So you have double thrust in the direction of the trend, non-thrust bars, double thrust, non-thrust bars, double thrust, non-thrust bars. In fact, we had a quadruple thrust there, 1, 2, 3, 4. But that was quite exhaustive and climactic, and that was the top of the market. Okay, so that's pretty much how the TNT buy setup works. So now we're going to talk about the TNT sell setup. So how does that work? So what we've got here is a couple of bars followed by, well, the first one, we don't know whether it's a thrust bar or not. The second one, we know for sure it was a bearish thrust bar because the close was below the previous session's low. So that's what I'm looking for. That's the first part of the setup. There's your T. That's your T for thrust, bearish thrust. Now I'm looking for a non-thrust bar, which is what occurred here. The market broke through the previous session's low, but by the end of the session, the market did not close below that low. So we've got a non-thrust situation. So thrust followed by non-thrust is TNT. So we have a bearish TNT setup in place. So trading strategy wise, I'm putting a sell stop just below the NT bar. So the TNT, we could call it the TNT bar. So if the market breaks through that orange line in this case, I'm going to be going short, assuming that we're going to see a resumption of the downtrend, which should mirror to some extent this kind of move down. So a window opportunity, if it breaks, to make money for the next couple of bars, at least looking for the market to trend lower, replicating what we saw before. Okay, so now let's see a few examples of the bearish TNT in action. Okay, so again, doesn't matter what the market is and what the time frame is. This occurs on many markets, and all time frames. So we kick it off with a double thrust to the downside, 1, 2. So this tells us that the sellers are likely to be in control of the market. We don't know for sure, but they are likely to be in control of the market. So after the double thrust, we can assume the market is, if not oversold, then maybe getting oversold. We wait for an NT bar, a non-thrust bar, which is what happens here. So what happens is the sellers come in, they sell the break of this one, thinking the trend is going to continue down. But by the end of this session, the market has bounced back and has closed above the breakout point. So anyone who sold the break of this bar here are now losing money. They're underwater at the end of the session. So we've had TNT. So now we can draw the line under the TNT lowest point, which is here, which is going to be the sell trigger. Next bar comes along, we get a push to the upside, but again, no thrust to the upside. It's a non-thrust bar. Okay, it's another non-thrust bar, but we're using the TNT. We're using the one which follows the thrust bar as our trigger. Next bar comes along and we break through it. So we've gone TNT, and then within a couple of bars, here we are breaking through the low of that TNT bar. That tells me that the downtrend is resuming and that we could take a stab at the short side of the market. And what happens again, we have quite an aggressive move to the downside, 1, 2, 3, 4. In fact, 5 consecutive bars, which saw a close below the previous bar's low. 5 consecutive thrust bars. You tend not to see that very often, to be honest with you. Usually when I'm trading, I'm looking for a double thrust. So I probably would have made a little bit of money and then got out and traded something else and missed some of this move. But what typically happens most of the time, I would say, is you get the double thrust and then the market tries to turn. So, there we have it. That was the opportunity there. Okay, so at the end of this thrust bar, we get another non-thrust bar, giving us another opportunity to make money on the short side. And then on this bar, we break down, and then yes, we see 1, 2 consecutive thrust bars, and then a bit of a turn bar, and then the market starts to go higher. Okay, moving on to another example. Excuse me. This one starts off with a bearish double thrust. Then we get a non-thrust bar here, and then the market breaks through the non-thrust bar's low, TNT, and there is a selling opportunity on that bar. So that's quite a good move, certainly for the intraday trader. Then we get a non-thrust bar here, so we can draw the line under this low, another one here, and that's the sell trigger hit there. Down it goes, 1, 2. Then we get another non-thrust bar here. We draw the line under the low. Inside bar here, nothing doing, and then this is the sell bar here. Down it goes. Same again here, and it's starting to break down here. Again, another example. This one kicks off with a single thrust bar, bearish bar. Then we get a non-thrust bar. The market breaks through the previous session's low, tries to rally, but closes above the breakout point from the previous bar. So we got TNT. So we can then draw our orange line under the TNT bar's low. That's the place that we sell it, and it breaks down on the next bar. That's the sell trigger. Down it goes, big style there. Then we get another non-thrust bar, TNT. Again, draw the line under the NT bar's low, TNT low. That's the place at which we sell it, down, 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 quite aggressively so. Then we get another push to the downside, but a failure. We've got a TNT low there, tries to break higher, but doesn't really follow through. That's the place we sell it, the TNT low, boom, boom. And then that turns out to be the low for the swing. Okay, so that was basically a bit of a run through of how TNT works on the upside and how TNT works on the downside, and the kind of sell trigger and buy trigger that I use. So before moving on, looking at the trading strategies that I've built around TNT, just a few words on the market orders that I use to enter and exit. So we have three types of order. Now, many of you will be familiar with stop orders and limit orders, but perhaps not so much with time-based exits. So just to recap, a stop order is an order to trade at a level away from the current price, at a less advantageous price, one would normally say. So a sell stop order is an order to sell below the current market price. So the price is, for example, at 150. You're looking to sell the market at a price of, say, 140. So you're looking to sell the market if it goes down. You're looking to sell below the current price. So what you're doing there is you are selling into market weakness. And if you're using that as an entry technique, as I do, the idea is to sell low and to exit your short position even lower. Also, we have a sell stop used for entering a short position and for exiting a long position. So these are the uses, either to enter a short position or to exit a long position. Conversely, a buy stop order is an order to buy above the current market price. So what you're doing here is you're buying into strength, buy high, exit long even higher. And I'm using a buy stop to either enter a long position or to exit a short position. Now, the flip side is to a stop order is the limit order. So a limit order is to sell at, I guess, a better price than the market price. So a sell limit order is an order to sell above the current price. So you're selling into strength. Similarly, a buy limit order is an order to buy below the current market price. You're looking to buy at a cheaper price level. So what you're doing there is you're buying into weakness. Now, I don't use limit orders to enter the market, just to exit the market at profit target levels, profit take levels. So once I've calculated where my stop is, I'll calculate where my profit objectives are, and I'll place limit orders at those price levels. Now we move on to the time-based exit. Now, this is not something that everybody, when you read about trading and about technical analysis, people tend not to talk about time-based exits. Now, a time-based exit is based on the premise that markets, they move one way for a few bars, then they move another way for a few bars. There's this constant ebbing and flowing of ups and downs as the market swings up and down. We tend to get this kind of, the market will swing in the direction of the trend, people will take profits, then the market goes in the opposite direction for a few bars, the trend will resume, and so on and so forth. So the reason I use time-based exit, basically just to get me out after a certain time period has elapsed. So an example of this would be, I'm in a long position, but I'm going to be in this long position only for 3 days. So get me out after 3 days have elapsed. Similar thing, you could say, well, I'm in a short position, I'm using a 5-minute chart. I want to be out after, say, 10 5-minute closes. So get me out after 10 5-minute closes. And that would be another example of a time-based exit. Okay, and the reason I do this obviously is because, as I say, the markets, they tend to swing up for a few bars, then they swing down for a few bars, and they swing up for a few bars, and so on and so forth. And we get this momentum pendulum constantly swinging up and down, up and down. And if you ignore it and you leave your profits on the table, you can quickly see them vanish. You can see them disappear. So what I'm doing is I'm kind of accepting the fact that market trades should have a shelf life. You're not in a trade forever. You're in a trade for a certain number of bars. Now, if you go back to that idea about this consecutive thrust bar action followed by non-thrust bar action, you can quickly see how I'm trying to sync the thing up with market price action. So the market's trending higher, you might see a couple of thrust bars in the direction to the upside, then you might see a couple of non-thrust bars against the trend. So why not get out after seeing a couple of thrust bars, because the market is likely to turn lower. So I'm using time-based exits to reduce my risk, to take my profits off the table after a certain time period has gone by. Okay, so now we can talk about a trading strategy built around TNT. So first question, how would I trade the TNT buy setup? So first things first, wait for the formation of the TNT bar. So in other words, we have a thrust bar followed by a non-thrust bar, and that first thrust bar being a bullish one where the close is above the previous bar's high. So we've got ourselves a TNT setup. So then I would place a buy stop just above the high of that TNT bar. And what I usually do is I buy it in a size which I can divide into 3 equal units. So 3 units, I would be placing a buy stop just above the high of the TNT bar. And the reason I do this is because I want to take profits at different places. I want to sell a third at PT1, I want to sell another third at PT2, and then I want to hold the rest of the position until the end, until the time exit kicks in. So if I happen to go long based on TNT, I've got to put my stop loss somewhere. Usually I'll put my protective sell stop just below the TNT bar's low. So what I'll be doing is I'll be using the TNT bar's range as my reference point when it comes to stop losses and profit targets. I'll hold my position for PT1 and PT2, and I'll move my stop up to PT1 after hitting entry after hitting PT1, and once I've hit PT2, I'll move my stop up to PT1, and then I'll get out on the time-based exit at the end. So this is kind of what the trade looks like. So I'll be buying the break of this green line here. This represents where the NT bar's high is. So I'll be buying here 3 units, and I'll be putting my stop under the low of the TNT bar. So that is my my risk amount in pips. I'll calculate PT1 and PT2. These are places at which I'll be taking profits. So when I hit PT1, if the market breaks up and hits PT1, assuming I've not been stopped out, because many times you will be stopped out, that's part of the nature of trading. Once we hit PT1, I'll be selling one of my 3 original units. We hit PT1, I can then move my stop up to my entry price, so that if the market then turns down, comes back down to my entry price, I just get out of the other 2 units. If the market continues to trend higher, hitting PT2, great. I'll sell another unit, and I'll then move my stop up from entry price to PT1, so that if the market reverses from PT2 all the way back down to PT1, I'll get out of my other unit, and then I'll take my profit and say thanks very much and move on. If, however, the market doesn't come back down to PT1, I just get out at the time-based exit. So if this happens to be maybe 2 days or 3 days, I'll just get out at the close of 2 or 3 days. Simple as that. I'll walk away and then let somebody else have a go. Now, let's talk what works on the upside should always work on the downside. So let's look at the TNT sell signal setup. So first things first, wait for the formation of the bearish TNT setup. And that consists of, if you recall, a bearish thrust bar followed by a non-thrust bar. If the trend is down, and we've seen that, we place a sell stop just below the low of the TNT bar, selling the breakout, looking for the market to break down. If we go short, I'll be placing a protective buy stop just above the TNT bar's high, and that means that if the market breaks up, I stop myself out, and that's the end of the trade, take a small loss. But ultimately, I'm looking for the market to continue down, not to take a loss, but it could happen. I calculate my PT1 and PT2, prices at which I'll take partial profits. And as the market breaks down, I'll be moving my stop along with it to predefined reference points to reduce risk and to lock in profits. At the end of my allocated time, the shelf life of the trade, I'll simply get out regardless of whether it's in profit or loss, and then move on to the next trade. So here's the graphical representation of the bearish TNT. So the market forms the TNT, and then I put my sell stop for 3 units just below the low of the TNT bar. Market breaks down and hits it, triggers me. I'm short 3 units. I put my sell stop above the high of the TNT bar. If the market breaks up, stops me out, I take a small loss. That's the nature of trading. But hopefully that doesn't happen. The market continues down, hits my first target, PT1, at which point my limit order kicks in and I buy back one of those 3 units. I can then move the stop down to break even, so that if the market bounces from PT1 to break even, entry price, I just get out of the rest of the position, the other 2 units, and walk away. I've taken a small profit. But if the market continues down, hits the second target, PT2, happy days. I buy back another unit at the limit using the limit order, and I can then move the stop from entry price to PT1, and that locks in more profits on that last unit. If the market then bounces from PT2 to PT1, stopping me out, I say, okay, not to worry. I've made profits on that as well. Maybe not as much as I wanted, but still a profit. Happy days. Walk away, wait for the next trade. Or if the market doesn't do that, I simply get out on the time-based exit. At the end of 1 day, 2 day, whatever it is, if it's a 5-minute chart, it might be 5-minute closes or 10 5-minute closes. Doesn't matter what you use, just something that kicks in and that says, okay, enough time has elapsed. We've given the market a chance to do what we want it to do. And if it doesn't do it, invariably, it might want to do something else, because the longer you leave the money on the table, the more chance that other participants have got to recognize what you're doing, to join your trade. And the more people that are in a trade, the less likely it is to occur, because you need more firepower to make that trade work. Okay, so get out on the time-based exit, walk away, thank you very much, and move on. Okay, so I'm going to summarize now. So TNT patterns are seen on all markets and all timeframes. So most of the time I tend to focus on foreign exchange, FX, but you'll see TNTs everywhere. You'll see them on Bitcoin, you'll see them on stock indices, you'll see them on gold and silver and crude oil. They're everywhere. You'll see them all the time because they are literally a reflection of market price dynamics. They tell you a lot about who is in control of the market. And as I say at the start of the presentation, technical analysis is all about patterns, and patterns are basically the way to define who is in control of the market. They reflect mass psychology. So TNT is just a kind of microcosm of technical analysis. So seen on all markets and all time frames. I would say with a lot of my stuff, a lot of my price action based strategies, they tend to work a bit better on, say, daily charts and maybe 4-hourly or 2-hourly charts or weekly charts, and perhaps not quite so much on, say, 5-minute or 10-minute bars, because there's a lot more random stuff that occurs on the very short term charts. But having said that, if you're looking for a particular signal, trying to fine tune it, looking at a 5 or a 10-minute bar chart, then maybe a TNT could be a good way into your trade. So back to the summary, TNTs are a visual demonstration of contracting volatility. So if you remember what I said about the market moves in cycles of volatility, low volatility followed by high volatility, followed by low volatility, and vice versa all the way through. So a breakout which follows a TNT bar in the direction of the trend often may signal a resumption of that trend. Okay, so TNT, a breakout in the direction of the trend, you'll be looking for a resumption of the trend. That's what I do. I'm looking for a resumption of that trend. I assume that a breakout in the direction of the trend after a low volatility setup such as a TNT tells me that that trend is resuming, and that gives me a trading opportunity. Okay, so as I say, a breakout following a TNT bar in the direction of the trend can offer a low risk trading opportunity. Why a low risk trading opportunity? A low risk because we know that our risk is defined as the other end of the TNT range, because that's what I've done. I've said, if I enter a long position, my stop is going to be at the other side of that TNT bar. So I know where my stop is going to be, and it's at the other end of a narrow range bar, typically a non-thrust bar. So I know that the risk in pips terms is usually quite small because I'm not risking a whole lot in terms of directional movement. Okay, so that's pretty much where we are on TNT. So if anyone's got any questions on this particular setup, please fire them through now. Be very happy to answer any questions that you might have. I know that a lot of the content is a little bit technical. I'm talking about thrust bars and non-thrust bars, double thrust, multiple thrust, all these kind of things. And maybe these terms are not that familiar to many of you. So if you have any questions, please feel free to fire them through now. Okay, doesn't appear to be any questions. Not a problem. I assume that everything is all totally clear. So if you excuse me, if you think of anything between now and the next webinar next Thursday, please feel free to reach out to me on LinkedIn. I post on LinkedIn on a regular basis, and very often you can find me there. So please feel free to reach out to me on LinkedIn. Separately to these webinars, just out of interest, I do a lot of one-to-one training. I do trading signals, systematic trading signals, and also I'm CEO of a company called Validus, which provides trading education, an education academy, trading education academy, which also gives people, members, the ability to earn reward points while they are learning how to trade. So that's something else that that might interest you. Okay, so again, thanks very much, and same time next week. Thank you very much. Take care.